Welcome to Yahoo Finance Live on this Friday afternoon. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on today's market action. Heading into the close, we're looking at gains right now for all three of the major averages on an intraday basis. Certainly, we started out the trading day in the red as investors reacted to some of the bank earnings that we got out from Wells Fargo, Citi, JP Morgan, Bank of America, all reporting their earnings before the bell. A bit of a muted reaction initially, but then we got a consumer sentiment number, which really kind of reversed that sentiment and made it a little bit more optimistic. It looks like we're going to hold on to those gains heading into the close. We have the Dow up just about 45 points. S&P also up about 7 points today. The Nasdaq 100 up about 0.3% on a weekly basis. All three of the major averages in the green here. Nasdaq, the outperformer of the three, up just about 4% on the week. The sector action, financials, one of the top performers in today's market, as well as consumer discretionary, as you can see there on your screen. The underperformers, real estate and industrials. And so far for the week, bit of a different picture. You have a consumer discretionary there, by far the outperformer, as well as real estate. Lagging behind is healthcare and consumer staples. I mentioned the bank earnings that we got out before the bell, and certainly has been a bit of a different picture as we take a look at these stocks here in the final hour of trading. You're looking at a lot of green on the screen, and that certainly was not the case shortly after the opening bell today. We had JP Morgan, Wells Fargo, Bank of America, all holding on to their gains here in the final hour trading. Citi up nearly 2%. Delta was also out with its earnings report before the bell this morning. Guidance is the issue there. The fourth quarter numbers were actually pretty strong. On an intraday basis, we're looking at Delta off just about 3.5%. It's keeping some of its competitors there in check. You have United right around the flat line. American Airlines still in the green, up just about 0.7%, Dave.
Delta's interesting. Had a pretty solid quarter. Not great guidance, but strong demand. A lot of airlines continue to say that. And bank earnings, we will get into some great commentary from the CEOs in just a bit. Thank you, Shauna. Let's get you up to speed now on the consumer. The University of Michigan's closely watched consumer sentiment index rising to 64.6 in the preliminary January survey. That's according to data released Friday. It's the highest reading since January 22 and up from 8.2% from December's 59.7 reading. It's still 3.9% below where it was 12 months earlier. Consumers' feelings on the economy, though, actually jumped 15% to 68.6, while inflation expectations, and here's the big takeaway if you're taking notes, this year the expectations are for a 4 spot, their lowest level since April 2021, and 3% is the prediction for 5 years out. Presumably that is what rallied the markets a bit, Shauna. It's positive and it's negative. I mean, look, 5 years out, we're still looking at a relatively high inflation mark, at least if you ask the Fed. But on the other hand, the 1 year mark tells you perceptions are turning a bit in the right direction.
And I think investors, I think traders are looking for any sort of optimism that they're getting here in the market. So anything like that, they're going to take that as a huge win. And that's a big reason why we are seeing stocks gains today. But let's talk a little bit more about those big banks, because we got 4 of the big reports today. Citi, JP Morgan, Bank of America, Wells Fargo among them. And I think the commentary from some of the CEOs is really what stuck out to me.
Yeah, it really has been an interesting day in terms of the commentary is also always the most interesting aspect of bank earnings. You get some numbers, but I think we're going to go ahead and dive into some perceptions of the market and the bank earnings as well. Now from Lee Munson, Portfolio Wealth Advisors President and CIO. Lee Munson, good to see you, sir. Happy Friday.
Oh, it's a happy Friday. After this, I'm going to be on the road heading to Taos to do some skiing.
Wow, that's a nice
Where are you going? Where are you skiing?
Taos Ski Valley, steepest and deepest in North America. So, you know, Valhalla.
One of my favorite places to ski in this country, my friend. You can bring me with me. I know you're flying private, so just throw me on the jet. All right, so let's talk about big picture bank earnings. We're going to break down some of the commentary from JP Morgan and Brian Moynihan and the likes in just a bit. But big picture, what's your number one takeaway when you put all the bank earnings today in perspective?
I'm old school. The only thing I care about bank earnings is that loan book expanding. I know we want to make it complicated about this. There's your investment banking going to come back. Please, Bank of America, solid loan growth. Wells Fargo, the bad kid always get in trouble, had 4% increase in consumer lending, 18% on the commercial side. I mean, my God. Citigroup, the value trap of all big banks, more strong loan growth. And then from JP Morgan, we already know they have strong loan growth, but I love it. Jamie Dimon, quote, "I shouldn't have used the word hurricane." What else do you need? We're going to be fine. Okay. Your government has this under control and the bankers are lending. And here's the thing. If you start seeing that loan growth go negative, that's when you want to stop, maybe not get so antsy on adding lower as the market goes down. But we still have wings for this, at least for the next 6 months.
Well, Lee, it sounds like your takeaway then is that the next couple of months is going to be a lot more optimistic. We certainly will be seeing a lot more green than maybe we had initially anticipated. How much higher do you think then that we could be headed?
Okay, so now here's the thing. Now let's get into practical trading strategy, okay? So remember last year how a lot of smart people said, listen, when you have the first 9 months blown up, generally in the fourth quarter, you can get a 10, 12% rally, Santa Claus rally. And then we got that right before Thanksgiving, right? We're hitting 4,000 and hadn't seen it since. Okay, so Santa Claus came early. And what did people do? They sent the gifts back. I'm sorry, if I see Santa Claus and gives me a gift before Thanksgiving, I'm going to get it from him because he's a busy guy. Markets are doing the same thing. All your big CIOs are saying, oh, the first half is going to be so bad. And really what's going on, there's a well-known stat that everybody knows about that says the market doesn't have the bottom until you get into the recession, right? And we're not technically in a recession. I would say that's baloney. We are in rolling recessions, just like the early 1960s. It was called the Eisenhower rolling recessions. Like, I don't need somebody to tell me we're in a recession. We're in it right now. So I think that we probably don't go lower than the October lows. I don't know. I'm guessing. I've only been doing this for 25 years. I think what's going to happen is people are going to be shocked. They're trying to front run the bad news of the second half. And just like how the Santa Claus rally came early, I think we could see another 10%. My God, we could see 43, 44, 4,500 before July 4th. And if you see it, pretend those are the end of the year numbers and trim down, right? You got to add load, you got to trim down. So I'm only looking to sell my overweight equities. Yes, I'm overweight. I took it down 5% back right before Thanksgiving. And if we see 43, 4,400, which you think is impossible, it could just take 2 weeks, just like that. VIX is getting crushed. I want to take more exposure off the table, right? Because nobody knows about earnings revisions in the second half of the year. We all know it's got to come down, right? But you got Cam Harvey, the father of using the inverted yield curve as a signal, saying we may not have a recession. And then you have other people who say the revisions of 4% growth in the second half have to come down. We don't know. So why not just be overweight, enjoy this rally, and then trim down if we get the opportunity. See if there's a blowout on the downside later this year. And then you have something to show for the bear market, right?
Man, Sean, I mean, we're done here.
You make it sound very easy.
We're done here.
You make it sound so easy.
So what do you say to those in that really large camp right now that say a 3,000, 3,200 S&P ahead?
You know what? I see this all the time. When you get down into the bottoms of bear markets, sort of like the end of bear markets, like the last quarter, last third, you'll get these bears that all got a big trophy last year for being right, at 12 o'clock high noon or 12 o'clock midnight. And like, oh, I'm a bear, I won. And then right at the end, just like in March of 2009, they give you these nuclear winter things. Like, oh, the S&P, I remember it was like somebody from JP Morgan say, oh, we can see the S&P go down to 400. And you want to avoid that. I say, if you want to bottom fish and you have this mind, because listen, I said the second half could be bad, right?
Yeah.
I'm looking more at the October lows, of last year, which to me, how is it different from the November lows? It's the same thing. It came back to the scene of the crime. So if we see 3,600-ish, all that money that I've been taking off the table, I am back in. I am locked and loaded. Let it go to 3,200, right? I don't need to try to catch that bottom on the tail end of a bear market, spouting from the mouths of people who were right last year. But Wall Street is littered with people who are right once in a row. And I just, over a couple of decades, I've learned, don't be so pessimistic. And I would rather, buy a little higher than the October lows if we get it. I think we probably will, and just call it a year because it's good value, be making money. You don't have to bottom ticket. And especially in a bear market like this, I think you have to be a little bit more realistic about what's happening.
We really got to get you to come out of your shell at some point, Lee.
I know. I hold back.
Man.
I hold back.
All right, you skiing bumps or you cruiser this weekend?
If you know me, you know there's only one thing I do. It's bumps in the steeps, in the deeps. I like the West Basin. Taos is a place where if you want to go and push yourself to the limit, right? Because I have to run moderate portfolios. I got to, most of my clients are like retired nuclear physicists. We just want to make a good return and not screw anything up. And Taos is my opportunity to do things that are wild, take risks. And my kids are on the big mountain ski team, so they're crazy. They're doing jumps off of bumps, off of cliffs. It's ridiculous. I'm getting old.
I want to go to Taos. I don't know if I want to go with you, though.
Oh, I do.
Don't go with me.
I don't know. I'm a little hesitant after all that.
We'll have a good time. Lee Munson, enjoy the bumps, my friend.
Thank you.
Appreciate it. All right, we're just getting started here on Yahoo Finance Live, even though it feels like we could call it a day.
Yeah, I know.
Feels like we could wrap it up.
Start.
We got a ton of bank earnings ahead. We'll break down their results and the commentary from the CEOs. Brian Moynihan among them. Also, Tesla slashing prices. Is it time to start treating EV makers like traditional automakers? And Delta shares trading lower on earnings. We'll talk about what they might reveal about other airlines. Don't go away.
Big bank earnings are underway. Wells Fargo, Citi, JP Morgan, Bank of America, all reporting ahead of the bell. Fourth quarter results were solid, but warnings about a possible recession keeping those gains in check. You can see Wells Fargo, though, the leader of the bunch today, up just about 3.5%. We want to bring in Ken Leon, CFRA's Research Director of Equity Research. Ken, it's great to see you. So first, just your overall take, maybe one or two themes that you think really emerged from the results this morning.
So what we got today is that we're not falling off a cliff. The U.S. economy and the consumer are actually very solid, and bank management still don't know what the first quarter or second quarter will be, but we think we're going to cross the valley and hit economic recovery in the second half of this year. That's a good position to be with a change of leadership, maybe to value or income, and that would be banks. And I think some of the CEOs like Brian Moynihan, he actually said, 5.5% unemployment from my team. I think it's setting the bar low for surprise on the upside. Similarly, from the other CEOs, we actually saw a pretty stable, calm picture. There's no distress industries as far as commercial lending. And there was a little uptake in terms of building loan reserves for credit card or consumer loans, but very modest to get to the historic averages. We have a pretty good picture here, and the previous conversation talking about where did we hit bottom here, especially for bank stocks, was sometime in October, November.
Yeah, Ken, good to see you. It felt like it certainly could have been, it was expected to be worse. Let's go through a couple of these banks individually, and we'll start, of course, with JP Morgan. You raised your target by $31. Why? What jumped out?
Yeah, so we also went from a hold to a buy, even with a substantial investment bank that's underperforming. They got a 20% return on equity. They got a 37% dividend payout ratio, which means there's more room on the upside for dividend growth. And they also announced, back to this conversation, whether we have dark clouds or recession, renewing a buyback plan. The board and Jamie Dimon wouldn't do that if they didn't feel that things are getting a little bit better. So I think with JP Morgan, they're doing great as far as the lending side, and that look in terms of spreads, and even if we hit peak rates in the next month or two, we're still going to see much higher net interest income, not as high as before, but then we see the pickup in business or volume in terms of loan activity.
And Ken, when it comes to Citi, they warned that expenses could climb to $54 billion. That was quite a bit higher than what the street had been anticipating. I know you still have a hold rating when it comes to Citi. Why are you staying on the sidelines?
Well, we once had, as 30 other analysts may have had, a buy on the stock. It trades greater than a 50% discount to net tangible book value of over 81. And anytime a management says we're doing a transformation, that means it's a multi-year restructuring. And they're really trying to finish the near term and get to midterm targets out 2 years. That's too long for my investment horizon for investors looking out 12 months. And you also have, what are the next catalysts? The ones we had in 2022 was selling off all the non-US consumer banks. That's done. So when we look at the bank today, we're not sure who is Citigroup going forward. It still has the highest percentage of international revenue, and they do compete against UBS and others. So I just think we have time to watch what Jane Fraser does at Citigroup.
You mentioned some of the commentary from Brian Moynihan, including the unemployment prediction. You raise your target there, and you reiterate a buy. What jumped out to you at BOA?
I think it's, if any large banks execute related to digital banking, getting the most out of their regional centers, and also having a strong position, as Wells Fargo has, in smaller middle market lending, it's Bank of America. And they still also have a monolithic, large wealth management business, and investment bank will come back as well. So they just do a great job in execution. They don't get rewarded for it like JP Morgan, yet they're going to be just as generous in terms of buyback of shares and dividend growth.
Ken, you also got a little bit more bullish when it comes to Wells Fargo upgrading the company to a buy from a hold. We know that they recently announced some changes to its mortgage business. CEO Charlie Scharf made some comments about that, just the fact that the bank needs to evolve as the market, as the picture does there. Why are you more bullish, or is that one of the reasons why you're more optimistic on Wells Fargo now, because of some of the changes that they're making?
Yeah, so it's a good transition from Citi. So in a multi-year transformation, they're kind of like entering year 4. and we're beginning to see the fruits of their restructuring. What that means is they have a new management team in place at 2 or 3 levels. Additionally, they are driving attractive consumer banking, higher net interest income. The whole notion, with mortgage banking is they got rid of the bad parts, which was wholesale and correspondent mortgage lending, and they just kept the direct mortgage area, which is small. Credit card, they're 10 years behind their competitors, but Wells Fargo still has pretty good brand, and that means they should get an uptick in terms of card income. Overall, and then they're investing, 1, because of regulatory compliance issues, 2, to get more streamlined with a digital platform. So again, they're in a transformation, but much further along than Citi, and yet the stock's back at 42, 44, and we think it's at least going to 50.
Yeah, up about 3.5% today following these results. Ken Leon, as always, thanks so much. Let's get to Tesla because shares are in the red today after the company announced that it's cutting prices on most of its EVs here in the U.S. and in Europe as well. Now, the company is cutting prices by about 20% from the Model Y and 6% for the Model 3. Pras Subramanian is here to discuss. And Pras, we talked about cuts elsewhere, specifically what we have seen price cuts in China. Looks like he's doubling down and extending those price cuts abroad.
Yeah, there was inventory building up of Model Ys and Model 3s here in the States, and people thought, hey, buyers are not buying these cars. So they know the price cuts are coming. They heard about it. They know it's happening because of the IRA changes. And here we are. They made the changes. Like you said, Model Y, the performance down 20%. Some of the Model 3s down a lot too. I think we have a graphic of that too. So basically what's happening here is that they're basically bringing those prices below that IRA level for the tax credit. So that's a big incentive. I mean, huge price cut plus an incentive like an EV credit is big for buyers, but that's going to hurt the margins pretty badly. And I think that's the concern for analysts like Dan Ives talking about how that's a big a short-term issue, but a long-term, it's like a way for the kind of company to kind of compete on scale versus other automakers.
Yeah, and what's behind that? Why is the demand lowering? A lot of factors there. Speaking of cutting prices, Guggenheim is cutting their price target on Tesla rather significantly, downgrading them to a sell. Why?
Very, very bearish note here on Tesla. Yeah. Cutting that down to $89 the price target. So, they see a big gross margin miss happening in Q4, which we kind of discussed here. Possibly more price cuts coming in Europe. Demand weak, declining waiting times is a signal of weakening demand. Plus used cars, Tesla used cars piling up now on different sites like Car Gurus and whatnot. So that's showing them that the demand problem is real, and that's what the price cuts are here. But they said bottom line, Tesla had to sacrifice one or two things: growth or gross margins, and they decided to take gross margins. So they're taking that down, and that's sort of the issue now. And are we going to value that automaker as value Tesla as a regular automaker going forward?
And the other automakers took a beating today, which was interesting. I don't know would you feel like it was related? I mean, it was surprising to see Ford take a pretty significant hit about the same time.
Definitely. This is the beginning of a big price war. I think this is 2023 will be the year that you can get a cheap EV because they're going to be competing on price because the cars are all pretty good, right? Mm-hmm. So the question is, can I get that cheaper? Can I get that model that I want right now? And if the price is $7,500 cheaper, I mean, there you go.
Yeah, and some of the other automakers, some of the competitors out there might be forced to lower their prices because of Tesla now lowering prices. I don't know, it'll be interesting to watch, but really we saw losses across the board today. Pras, thanks so much. We'll come in next, GE Healthcare, the spinoff from General Electric, known for making hospital equipment like MRI machines. We will talk to the company's chief technology officer next.
GE's healthcare spinoff, which just began trading about a week ago, marks what could be a more aggressive strategy in the healthcare space. Already made one major acquisition, nabbing a top health tech veteran. Anjali Kamlani joins us with a special guest to discuss GE Healthcare, which is a very interesting play in 2023, Anj.
That's very true, Dave. And joining me now to discuss it all, GE Healthcare's Chief Technology Officer, Taha Kasu. Taha, thank you so much for joining. It's so good to see you again. Last time we were in person, but here we're virtual. Let's talk about this move. Why did you leave Amazon, of all places, to come to GE? What's going on there that we don't know about?
No, it's really awesome. Thank you so much for having me in person. I mean, of course, I believe the spin was among the perhaps the largest in mid-tech industry today. I mean, it's a catalyst moment for us here at GE Healthcare. And we could not be more excited about a future and what the future holds. I mean, the future is really bright to truly create a world where healthcare has no limits. The GE passion, healthcare, passion and purpose and commitment to lead digital transformation across the globe in healthcare and improve outcomes for patients and providers, clearly aligns very much with my passion and purpose.
And everyone knows about that passion. You were brought in to AWS to help build out what is now a really well-known healthcare project. We see how much digital technology, AI, and all of that is going into really every aspect of the health system, including something that we've all been talking about here often is the production of new drugs and how AI is really helping with that. So let's talk about what GE can benefit from. What is it, as mostly a med tech company, what is the strategy? What are they looking to grow out as an independent firm?
Building on a shoulder of a giant. GE Healthcare has been around for a long time, and it's a company of many firsts. The first MR device, CT scan, and ultrasound, bringing those to diagnostics and screening around the globe. And really where the big transformation is going to happen is this sort of the D3 precision care strategy. It's a framework that GE Healthcare and its leadership stands behind based on a lot of customer feedback we've gotten over the years, around digital products that truly emphasize the company's smart devices, and that's aligned from to disease states that's enabled all by digital. As you can imagine, a patient walking through their entire patient journey, the medical diagnostics such as lab testing and imaging is a critical piece to aid clinicians, but also to kind of spot disease early. But if you look at kind of zoom back out into how can you leverage all that information in a way that truly now can be personalized to clinicians to make better decisions, a clinical decision, better, more guided therapeutics and targeted treatments, but also for a patient to really have more personalized options along the way. So we're coming from building from a position of strength, having been embedded in pretty much the clinical workflow around the globe in the clinical diagnostic pathways and patient journey, and really now try to transform entire healthcare journey from that lens in order to truly start enabling precision care and precision diagnostics.
So Taha, I know that you've been on the ground really for developing technology within the government agencies, FDA and CDC. We know that you've spent a lot of time in this space. So you're no stranger to the concerns of digital health, including security, cybersecurity, privacy, as well as bias. Talk to me about what you see in that space and whether this is something GE can also tend to.
Absolutely. Patient privacy is, of course, top of mind. Cybersecurity is top of mind. As I always used to say, it's a job zero for anybody's trying to do this line of work. But what the cloud, for example, provides and the scale it can provide from privacy, security, adherence to compliance regimes, around the globe, and because patient data is very, very private, but here the leverage that you have also with GE Healthcare is the wealth and knowledge of medical diagnostics being in the clinical workflow across the globe in every single line of therapeutic, and then bringing a lot of our strength in medical imaging and guided therapeutics, in these high fidelity sort of medical imaging. But then also, now you're trying to triangulate all this information, not just from medical devices, but really all the information that kind of flows around the patient along with it. How can you make sense of all that data? For better monitoring, for example, reducing hospital readmissions, trying to be able to really help clinicians get a 360 view about their patient's entire journey, try to make the right decision at the right time. This is really sort of the future we're trying to paint. And my new role as the architect of this D3 strategy, smarter devices, digital products and applications, but also digital platform to build on and invite a healthy flywheel from around the globe of innovators, especially trying to bring more artificial intelligence applications into the mix, from acquisition of an image to reconstruction of an image to actually now personalizing the entire therapeutic pathway or the personal journey of a patient or a clinical decision support by clinician.
And so I just want to, you were talking about bringing all the patient information together. So just really quickly, as a last question, do you see a space where GE can help to enter the consumer space on that side? There's a lot of focus on, remote monitoring and the like. Is that something that you think is on the table?
I mean, GE Healthcare in monitoring has a long stand, especially in cardiology. I mean, but that's within the walls of a hospital, or if you have a patient now, they're at home, and how we can really kind of bring all that information together. And from that lens, we will continue to work backward, truly from customers' needs, and in this case, our healthcare providers and clinicians, as well as a really healthy flywheel of pharma companies that trying to better understand, how can they better target their therapeutics to these patients. So we're really looking more healthy sort of view around this. Truly build an open sort of approach and a framework where we can invite more innovators and create that healthy flywheel of other innovators can come in and offer the best they can, but around really start focusing on disease state, meaning that now you're not just looking at point systems about, what can you acquire the data, for example, about this one medical image modality or another, but truly look now more holistically about what is the best option for this patient given where they are in their health journey. Whether somebody would, say they had one type of cancer, one type of cardiovascular sort of condition, or be truly now push the envelope into helping our healthcare providers better manage their population, manage their costs, and operate more efficiently.
Well, we'll have to leave it there, but definitely really interesting to see where this company goes and what you are going to do with it. GE Healthcare Chief Technology Officer Taha Kasu, thank you so much.
Thank you so much for having me.
Great interview, Anj. Thanks so much. Coming up, Lionel Messi is not only shaking things up on the pitch, the World Cup champ is also shaking it up with his clothing line. We'll tell you about this dramatic rise and fall that you have to see after the break.
Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Salesforce, MGO Global, and Carvana. Our very own Josh Schaefer is here with us. Let's kick it off with Salesforce. The stock getting downgraded by Atlantic Equities. They cut their rating on the stock to neutral, lowered their price target to $140 a share. The company cited a number of reasons for the lowered outlook, but it did include the execution concerns, slowing growth that we've been talking about when it comes to Salesforce. Also, recent management departures. Both co-CEO Brett Taylor and Slack CEO Stuart Butterfield recently announced their planned departures. It is the second downgrade that Salesforce has gotten this week. They also announced company-wide layoffs a couple of weeks ago, just in terms of cutting their costs, trying to adjust in this slowing growth environment. But certainly it sounds like from the analysts that have weighed in so far, we could see further downside ahead for this name.
Definitely, Sean. I mean, in the short term, though, it's been interesting to watch this week. The stock's up about 6%, I think, over the last 5 days. And you saw that partnership with Walmart. So it seems like while the street is sort of questioning where things are headed in the long term, investors aren't really bailing out quite yet. Now, we have seen investors bail out of a different name today, though, guys. My play today is MGO Global, and it began trading under the ticker symbol MGOL. Now, this is the operator of soccer star Lionel Messi's clothing brand known as the Messi Store. The stock has been on a wild ride. Take a look at that chart. It was up almost 200% or more than 200%. And then it's come crashing down, Dave. And really to kind of explain why that is. So it's a very small stock. And they had revenue of under $500 million in the first 3 months this year. Or sorry, under $500,000 in the first 9 months this year. But to really sort of explain how this works too, is they only issued 1.5 million shares. So that can make it very volatile. To give you sort of a reference point, another smaller retail name that we've seen IPO, Allbirds. We all know the shoes, right? Yep. That was 19.2 million shares in the IPO. So nearly 20 times as many shares. So it's a little harder to move the stock price when there's so many shares. And that Allbirds has a $350 million market cap. So that's why the stock is probably moving so much, but also it's because of Messi's fame, right? We've seen Messi take off since they won the World Cup. And I think that's really what had people excited today. But that doesn't necessarily mean that this is a company that investors should be looking for the long term.
Yeah, started by Tommy Hilfiger's sister. And I was curious if he was a shareholder, could not find him as a disclosed shareholder in the company. It's more of a royalty play for him. I think he gets 12% of net sales. But look, all things Messi have taken off. 700%, the people naming their kid Messi in his home country. The Saudis want to pay him $350 million a year to come play soccer there with Ronaldo. All things Messi, other than the MGO Global, trading pretty well. My play is Carvana. Speaking of crashing yet again on news, this time from the Wall Street Journal. The online used car seller is, quote, quietly terminating employees, cutting hours and letting open positions go unfilled. That's according to the Journal. Carvana laid off 4,000 employees, 1/5 of its staff last year. JXCE data shows fourth quarter sales are expected to fall to 86,000 from 113,000 a year prior, same quarter. Cars sitting on the site 97 days on average. That's up from 65. One component, if you want more news, of Thursday's CPI index, a nearly 9% drop in prices of used cars and trucks over the prior year. Good news for you and I, not so much for Carvana. Their stock soared 40% on Wednesday on what appeared to be a meme trading day, along with Bed Bath & Beyond. But then that ran back out of gas. So they're down 95% in the last 12 months. And as you can see, dropping 12% today as well. As I look through a real estate perspective, Shauna, if this were to go, this is a lot like movie theaters. Movie theaters are on a slanted ground. No one knows what will happen if movie theaters go away with that real estate. It's almost impossible to convert them. These giant vending machines, many of which are sitting empty across the country, what can become of them? I'm not saying they're done yet, but they are circling.
They're doing all they can to stay alive, but they have over $7 billion in debt. They need to do something. Laying off 1/5 of their workforce last year, quietly laying off firing some of their employees today or in recent days isn't going to do the trick. There's so many questions out there about what is exactly in store for this company. Is it even an option that they are going to be able to turn it around. You mentioned the fact that cars are sitting on their site for much longer. They're not able to sell it.
100 days.
Exactly. And with the car prices falling, the longer that they sit on it, the more and more money that Carvana loses. So clearly a uphill battle for that company.
And just another story of sort of coming back to life when we talk about these stocks and these meme stocks, right? It was a big week for meme stocks. Carvana up almost 60% on the week. But the real fundamental news isn't there. It was the same thing with the Messi stock we talked about, and sort of a trend we're seeing in the market right now, Dave.
Certainly. All right, Josh, thanks so much for hopping on here for that. Well, coming up next, volatile markets, inflation, and new legislation are changing how people are planning for retirement. We've got what you need to know in 2023 next.
You can now invest more in your 401k and IRA in 2023, but should you? Let's talk retirement now with Silver founder and CEO Rian Horgan, brought to you by Fidelity Investments. Nice to see you. So not all say you should be maxing out your 401k and your IRA given the state of the economy and the markets. What say you?
So it's a good question. I think as consumers are starting out the year, the key thing to think about is that most consumers have time on their sides. So we look at last year, obviously the markets were down almost 20%. So the average consumer is probably feeling a little bit of pain in their retirement savings. But if you think about really investing for that 20 or 30-year time horizon that many people will spend in retirement, getting invested is actually really critical at this moment in time.
So you talk about getting invested for people that are looking to save up for retirement. What's the one or two things they need to do first or think about first?
Yeah, so I think the first thing is really making sure you know where you stand today. And so the first thing you do is actually get a retirement plan in place, get your account balances updated. Again, if you're working off numbers from last year, they're probably not correct. So get the numbers updated. When you're updating your numbers, not only think about updating your financial savings numbers, but think about spending. Spending is all about, really making sure that you understand, how the inflationary environment is impacting, what your monthly spend is and what it'll be in the future. I'd also think about retirement income, getting a check-in to see what your retirement income looks like. Last year, Social Security increased the cost of living adjustment by about 8.7%. And so it's likely that your projected retirement income is actually higher looking forward than it was the last time you checked.
How do you factor in the recent market performance given the struggle of the S&P last year and a lot of predictions of a 3,000 low coming?
So I think if you actually think about investing over the long term, most retirees are really thinking about investing over a 10, 20, 30-year time period. So if we think about long-term returns, given that we now see higher yields on bonds as a base, actually, I think many investors, when you think about investing over a cycle, think about now as a really great time to start averaging in. And again, thinking about you are investing over the long term. This isn't about perfectly timing the market, but thinking about putting your capital to work over the next couple of quarters.
You're on the front lines of this. You're having conversations with people who either are in or planning for retirement. What are some of the trends that you're noticing given all the uncertainty out there? And I would believe people are a little bit scarred by what happened last year.
Yeah, so look, I think this last, not even just last year, but the last couple of years have been a time when I think a lot of soon-to-be retirees are reevaluating their plans. They're thinking about where they live in retirement. Where you live could actually probably be the biggest retirement decision you make because of the differences in taxes in different states, the different costs of healthcare. The second thing is that retirees are really thinking a lot actually about the cost of healthcare in retirement and planning for it. With the average retiree spending upwards of $5,000 a year on healthcare costs in retirement, it's something they really have to plan for. And so I think for many retirees, as those numbers become more and more clear to them, they're taking a much more proactive step in adding that retirement healthcare cost to their budgets.
Ryan Horgan, great to have you here joining us as part of our Retirement Ready series brought to you by Fidelity Investments. Well, coming up, Wall Street CEOs have a view of the economy unlike many others. We'll take a closer look at what a number of them said this morning following their earnings reports. Stay with us. The first wave of bank results are out. Wall Street wasn't initially impressed. Why? A lot of that had to do with the outlook and the commentary that we got from CEOs on the call. So let's dig into some of these common themes. First up, we want to talk recession. JP Morgan CEO Jamie Dimon shifting his tone after warning of an economic hurricane last year. He's now calling for a mild recession, and he is far from the only one. We certainly heard that from Citi CEO Jane Fraser, also Bank of America CEO Brian Moynihan. Now, Fraser went on to say that we've built reserves in personal banking this quarter on the back of volume growth, as well as that anticipation of a mild recession. Moynihan went on to say that their baseline scenario contemplates a mild recession. So, Dave, recession was heard a number of times, but I guess if you want to take the optimistic view on this one, it's only mild.
What does that mean? Define that.
Hopefully it won't be that bad.
I suppose. I couldn't help but wonder if they coordinated this reference, because you heard mild recession in just about all of the commentary from the big bank CEOs. It seemed to be almost a coordinated message if you were just dropped down on this earth. The one thing that really scared me, though, was Moynihan suggesting a 5% unemployment rate through 24 and a potential for a 5.5 unemployment rate, which is scary. Folks, we're at a 3.5 right now. JP Morgan CEO Jamie Dimon, we're all waiting on these words. And here's what he said. He's focused on geopolitical events. We still do not know the ultimate effect of headwinds coming from the geopolitical tensions, including the war in Ukraine, the vulnerable state of energy and food supplies, persistent inflation that is eroding purchasing power and has pushed interest rates higher, as well as the unprecedented quantitative tightening. Now, what we didn't hear when he talked about geopolitical concerns is I wanted to hear something about reopening in China in terms of optimistic tailwinds. Didn't reference that when discussing all these events going on around the globe. Was a bit surprised, but again, he seems to agree on the side of mild recession.
Yeah, and also the loan loss reserves, right? That's a number that we've talked about very frequently over the last several quarters. JP Morgan, Bank of America, Wells Fargo, all adding to that. JP Morgan actually adding $1.4 billion to loan loss reserves in Q4. Bank of America provision for credit losses growing to $1.1 billion. Wells Fargo, $957 million. So there is some concern out there in terms of what we could see over the coming quarters. Consumer was another common theme, just in terms of the strength of the consumer, maybe lack thereof. Although it was a little bit more upbeat and optimistic than I had anticipated that we would be hearing. Dimon saying that the consumer's still in good shape. Brian Moynihan saying consumers, quote, have plenty of cushion left, although he did comment there, go further, saying that some of that spending growth is slowing a bit. Well, you take into account the higher prices, the looming recession, the fact that consumers have been holding up and actually stronger than we had anticipated, I think that's pretty good.
Yeah, Moynihan did say outstanding credit balance is up 14% year over year, and did say delinquencies are beginning to rise. We expected, at least I did, expect to hear more about layoffs, because we did hear the reporting that Goldman Sachs, who reports next week, will lay off 3,200. Didn't hear a whisper other than that, which I think was surprising and gives you some optimism going into the year when you thought you might follow suit from Goldman's.
Yeah, certainly, because I think a lot of us were bracing that we would hear about more cuts and layoffs here. But actually, when you take a look at these headcount numbers, JP Morgan, Bank of America, both of those banks had higher headcounts than they did the previous quarter. And Bank of America going on to say that they have no plans for job cuts at this point. So pretty optimistic when you take into account where we are today.
Absolutely, no question. All right, coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live.
We are minutes away from the closing bell. Let's take a look at some of the day's biggest movers. We want to kick it off with Wendy's because that intraday chart, looking at gains of nearly 6%. The company rising on positive prelim fourth quarter results. Same store sales increasing 6.4% from a year ago. Net sales climbing 13.4% to more than $536 million. Also more positive news for Wendy's, moving the stock today with a regulatory filing revealing that activist investor Nelson Peltz will not be pursuing a takeover of the fast food chain. Again, gains of just about 5.7% today, Dave.
Yeah, Nelson Peltz will concentrate his attention on Bob Iger and Disney. That is nice to hear if you're Wendy's. Also nice that he said believes strongly in the future of Wendy's. McDonald's will also do a bit of a restructuring similar to what we heard from Wendy's. So we may hear more of that, but certainly some good news, all upside there. For
an important name to keep an eye on. Let's talk about Amazon because we're looking at gains of just about 3% today, but it has been a trender all week on our site. Shares up just about 15%. Let's take a look at that 5-day chart. You can certainly see that climb to the upside. Investors have been piling into this name to start the year. Shares up about 16% so far since January 1st. And Dave, you would think a lot of this optimism potentially has to do with the inflation print that we got, the jobs number, what that has shown, what that could mean for Amazon going forward. Because when you take a look at least at the retail part of their business, you would think that that has exposure to that looming recession, and maybe this wouldn't be the best play at this point.
Of course, you're getting that retail basically for free when you look at it. Jason Helfstein from Oppenheimer actually cut his estimate for AWS, and it's still largely an AWS story, cut his estimate by between 1% and 3% for the fourth quarter and for all of 23, but says he's mainly optimistic. One side note here, Amazon is actually to blame for NFL ratings falling a couple percent this year because Thursday Night Football was lower than what we saw last year. Bit of a sidebar, not related to the stock, but I certainly thought it was interesting.
It will be interesting to see what they do in their streaming business and how much more they could potentially spend on sports here going forward. All right, let's take a look at this board because as you can see, certainly a lot of red on the screen. All these automakers here. Now, Tesla, the news today, cutting its prices across several of its models. That appears to be a warning sign about potential demand impact that it could have on a number of these names. You have Rivian, Ford, GM, all sinking lower. Ford off just about 5% today as we look at that intraday chart, which isn't popping up there. Rivian off about 6%, GM off about 4.8%. So some concern there about demand, Dave, that they're going to be forced to lower their prices, pressure margins. That's a big thing. All right, let's get you over to the closing bell.
There we go, your closing bell on Wall Street. Let's check out how we finished out this week. It's been largely a pretty solid week. We talked about the CPI data earlier in the week, bank earnings today, and then possibly really turned on the University of Michigan consumer sentiment number. Inflation expectations pretty solid, best since April 2021 in terms of the one-year outlook by the consumer. And there's your finish. The Dow gaining 0.3%, 112 points. The S&P's up 0.4%, and the Nasdaq also rising 78 points on the day. Shauna.
All right, let's take a look at Delta because earnings were out soaring above expectations in the fourth quarter, but the airline continuing to see headwinds after trimming its guidance, also citing profitability concerns. Here to discuss, we want to bring in Savi Saith, Raymond James Managing Director. And Savi, when you take a look at the reaction here, some bit of concern from the street about what we saw from Delta. Fourth quarter numbers, though, look pretty solid to me. What do you think?
I think the fourth quarter numbers was solid and it definitely beat expectations. I think it was the first quarter. And if you look at it, the revenue and the top line commentary is really strong. So I think there's a little bit more of an optics issue here where some in the consensus figures had costs that had the pilot deal. Some had it partially for the quarter and some had it for the full quarter. So I think the reaction here is a little bit more to do with optics than reality. Also, if you take a look at their 2023 cost guide, it hasn't changed, but the quarterly progression was a little bit different than we were thinking. And so I think it's more optics than a really kind of disappointing update here.
Yeah, really just a lot to do with that new pilot contract that has not been ratified by the union yet. Ed Bastian saying he's never seen a more constructive backdrop for the industry. What do you make of that statement by the CEO?
Like, I think if you look at third quarter 2022 or the second half of 2022, the airlines have fully recovered the fuel price increase, which has doubled versus 2019, even though you have several components of demand that haven't recovered. You don't have a lot of large corporates that's still coming back. Some of the long haul international demand still coming back. So with these demand kind of avenues still recovering and showing good progression on recovery, I think they feel like the setup is pretty good. Obviously, what everybody's worrying about is, what the macroeconomic front will bring with some of the layoffs that you're seeing and with what the Fed is trying to do, which is slow things down. But as it stands today, I think everything is looking quite strong from an airline demand perspective.
Savi, so that's Delta's story. I know you also cover American Airlines, and we saw the stock pop earlier this week, hiking their revenue and their profit outlook. The position that American is in, comparing that to what we've seen from Delta, how do they stack up?
I think, all these airlines are seeing a pretty similar environment. What I would say from a kind of a legacy carrier, American, Delta, United, they're all benefiting from the fact that you still have long haul international that is recovering. You just started to see Japan open up. And a lot of the Pacific markets are, finally in the fourth quarter and into the first quarter are recovering nicely. And you heard Delta today talk about South America, that's deep South America, that's starting to finally recover and show good momentum. So this is really good for these legacy carriers that have international exposure. So I think the American revenue beat in the fourth quarter was stronger. But generally, I think they're all seeing a very positive environment here from a demand perspective. Admittedly, with 1 to 3 months of visibility versus what investors are worried about.
Yeah, all of them facing a couple of headwinds, including deliveries and supply chains and pilot shortages. Do you expect those to clear in the year ahead?
Yeah, for the legacy carriers, I think the big thing is a training bottleneck as it comes to pilots. You're trying to train. You're hiring 4 times as many pilots as you've hired in the past, and the training footprints have been kind of slow to expand. And it sounds like we should, as we head into the summer, be fully caught up, at least at the kind of the large airlines here. So that should start to ease. You're right about the supply chain. I think that's going to take longer. If you listen to the various OEMs, it sounds like something that's going to continue into 2024. Paradoxically, I think that might be good for the industry because it will hold back capacity, especially in an environment where you might see some demand softening as well.
Savi, let's talk about Southwest because I know you cover the stock. Certainly has been a rough couple of weeks for the company as they're trying to win back the trust and really consumers who were delayed and maybe never got on those flights during the holiday week. Talk to us just about the brand damage that you think Southwest is facing right now and whether or not you've changed your outlook on the stock as a result.
Yeah, it's not good. And brand is something all these airlines, protect jealously. And so they've definitely taken a hit here. What we've seen historically, though, is that consumers tend to have short memories. I think it will be important that Southwest doesn't repeat this again this summer, but as long as they kind of get the act together and make sure they address this going forward, I think we'll see that for the most part, collectively, we'll have shorter memories and the brand will, over the longer term, not be as impacted. But they do have to take steps to make sure that this doesn't happen again.
You estimate an $825 million hit, half of that due to lost revenue in those 16,000 canceled flights. Given what we saw from American and Delta, expectations for United, who will report next week?
Yeah, I think you're going to see a similar commentary about kind of strong revenue environment. Again, they have greater exposure to international, and that's the area that's recovering. So we expect a kind of pretty good setup here. They similar to American, they hadn't updated their fourth quarter guidance, and so there could be kind of a potentially stronger environment there. You saw both Southwest and American having some rebookings from maybe Southwest customers that help offset the damage from the storms, their own kind of revenue loss from the storm. So you might get that similar offset. So it looks like a pretty decent setup. Again, the question for United American is when are they going to get their pilot deals and when is that going to get reflected in numbers?
No question about that. Every pilot is empowered right now to renegotiate with their union. They hold all the cards, so those salaries certainly going up. Savi Saith, Raymond James, good to see you. Thanks so much. Enjoy the weekend. Treasury Secretary Janet Yellen warned Congress the U.S. may need to take extraordinary measures to keep the U.S. from defaulting on its debt, which could happen as soon as Thursday, January 19th. Yellen says the measures will buy Congress some time to raise the debt limit. They'll have until about June to get it done, but it's going to be a real fight. House Republicans have been threatening to leverage the debt ceiling to enact spending cuts Democrats don't want. And the debt ceiling was last raised in December 2021. This will be a real battle.
All right, coming up next, also in Washington, House Speaker Kevin McCarthy officially inviting President Biden to the Capitol to deliver his State of the Union address on February 7th. Now, McCarthy tweeting, quote, "It is my solemn obligation to invite the president to speak before a joint session of Congress on February 7th so that he may fulfill his duty under the Constitution to report on the State of the Union." Coming up, Tim Cook taking a big pay cut. We'll tell you why next.
Taking a pay cut is unfortunate, but asking for one yourself, well, that's just what Apple's CEO Tim Cook did for 2023. For more, we're joined by Yahoo Finance's Ali Garfinkel. Hi there, Ali.
It's surprising, Dave. I've personally never asked for a pay cut,
No.
but I will say there's kind of a lot going on here, and I do wonder if this isn't preemptive on Cook's part. Now, why? I'll give you this statistic. Only about 64% of Apple shareholders approved of Tim Cook's compensation last year. And if those filings are to be believed, there could be more changes coming. Now, remember, only 2 years ago, about 90% of Apple shareholders approved of Tim Cook's pay. So we're kind of seeing a little bit of a sea change at Apple here. That said, don't feel bad for Cook. If you look at the numbers for him, he is still making quite a lot of money, though notably it is less than some of his colleagues. For example, if you look at the numbers for the total compensation for, say, Sundar Pichai at Alphabet, he's looking at $280 million a year. If you look at Andy Jassy, he's looking at 213, and now Cook at a paltry 147 million. That said, again, we can be coy about it, but executive compensation has actually been coming under increasing scrutiny last year. For instance, the ISS recently told Apple shareholders to vote against Tim Cook's compensation. It's also, I think, worth saying that in the case of Apple, Tim Cook has been at the top for so long, but this could be heralding a new era for both him and for Apple, where there are new pressures and new fears.
All right, Ali, well, in other Apple news, the company's first store to unionize began negotiations with management this week. I think it could be a big concern here for Apple. How are those talks progressing?
So I think it's important to say off the bat, Shauna, this is a landmark moment not only for Apple, but for big tech. This is the first time one of these companies have sat down at the table with workers to negotiate with a recognized union. And I would say for Apple and for tech at large, this is pretty high stakes because it could set the tone for the labor conversation going forward. It could set the tone for what's possible for workers who are unionizing across the country. Many of these workers are actually at tech companies. For instance, of course, you famously have the Amazon Labor Union. You also have a series of unions popping up at Activision Blizzard and, of course, at Alphabet. And then, of course, most famously, arguably, the Starbucks union push has really captured the public imagination. So in the end, Shauna, how's this going? Well, it's going to take a long time. The average negotiating period for a contract is more than 465 days. So we're really far from knowing exactly what this is going to look like. But I think it's safe to say that workers across the country and fellow tech companies are going to be watching how this plays out.
All right, Ali Garfinkel, thanks so much for staying on that story for us. Virgin Galactic shares closing higher today and anticipation growing for commercial trips. You're looking at gains of just about 12.5%, and that's commercial trips to space. The aerospace company noting in a release Thursday night that it is, quote, on track to support commercial space line operations in the second quarter of this year. Virgin Galactic also stating in the release that we had several executive shakeups to bolster those commercial operations, including the departure of the company's president of aerospace systems. Now the stock popping today, but that has been after a wild ride over the past few years, looking at losses of just about 81% in the last 2 years alone. And Dave, when you take into account a lot of excitement about the fact that we are close potentially to commercial service when it does come to Virgin Galactic, you got to get ready to pay up if you're going to want to be on one of these flights. $450,000 for a ticket potentially. That's crazy.
Potentially, yeah. That's what they said February of last year when they discussed this plan. So $450,000 per flight. That's with a $100,000 deposit. At last check, however, they did have about 800 reservations that they managed to put on hold until what it sounds like maybe second quarter. But yeah, you're talking about a very small portion of the world that can afford this. We've seen Blue Origin get into this, the business space tourism now with, I think, 5 flights. Michael Strahan, Bezos himself flying, and William Shatner. But how long can this go? The real question is, how low can they bring that price point in order to bring it to ordinary Americans? I just can't imagine it's going to get anywhere close enough for ordinary people around the world to even consider it.
Yeah, I agree with you, but I also am genuinely curious in terms of how many people would actually be willing to take the risk and go up in one of these things. I have a feeling that you actually would you?
Absolutely. My wife would say no.
No,
like that's how these things go.
I would be way too scared. It would be interesting just to see exactly how much demand there is out there for this, because yes, it's really cool. There's so much excitement when we talk about this and the fact that we could be getting closer and closer when it comes to Virgin Galactic. But I still would venture to guess there's a heck of a lot of people out there, the majority, that would be very, very hesitant. Which would be a good thing.
My friend. I think you are on the timid side of this.
Really?
I think millions of Americans would absolutely sign up for this if it were anywhere approachable. But $450K, even if it were cut to $100,000, which we're not 20 years away from, I can't imagine that Americans would sign up for what amounts to 15, 20 minutes in space?
Yeah.
No.
Yeah, no.
We're nowhere near space tourism.
So yeah, that price is going to need to come down quite.
So you wouldn't go for 10 grand?
No.
You wouldn't go for free?
I would like maybe send you up, everyone else.
Well, I know you'd send
have
me up.
everyone go on their test flights. If everyone comes back down safely, then I will get it.
You wouldn't go for free?
Not right now, no.
Wow.
Yeah.
How about Blue Origin? It's okay, all right.
Patrick was like, yeah, you know, I take the risk.
It's not
for
a
Bezos.
Branson thing.
Yeah, no,
okay.
it's not.
Okay, coming up, the FTX contagion spreads now to crypto.com. We have the details on the crypto exchange's job cuts. Next.
Crypto exchange, crypto.com cutting more jobs. David Hollerith has the details for us. And David really just speaks to the tough environment, challenging environment that crypto is facing right now.
Yeah, by head count, retail-focused crypto.com is estimated to be one of the largest firms in the space, and they announced about 20% layoff around 1 a.m. this morning. So crypto.com is well known for its huge marketing budget, which has included sort of features like the Matt Damon ad, purchasing naming rights to the LA stadium, and also more recently being a sponsor, one of the major crypto sponsors in the World Cup. And crypto.com CEO Chris Marsalek said in the announcement this morning that the cuts were due to major growth in 2022, followed by crypto's downturn. Specifically, he named the collapse of FTX for having significantly damaged trust in the industry. Now, following Friday's cuts, crypto.com's estimated to employ somewhere between 3,600 and 4,500 workers. Their cut follows layoffs of 260 workers in June and reportedly another 2,000 between June and October. A spokesperson for the company would not comment on the current amount of employees they have. And obviously, we're just 2 weeks into 2023, and crypto businesses are still fighting a hangover from last year, starting with crypto-friendly bank Silvergate, followed by another exchange, Wobi, Genesis, Coinbase, Blockchain.com, and Consensus. Our estimates have crypto firms already having laid off about 2,600 workers this year. And based on those numbers and sort of adding them with those collected by layoffs.fyi, which is a company that tracks job layoffs across the tech sector, total layoffs for the crypto space have accounted for around 11% of all layoffs across tech companies, which is about 23,000 employees so far in January.
Boy, David, I'm sure glad you mentioned that LA arena, man, because I can't imagine how an employee feels getting laid off knowing $700 million is going to name a sports arena. That is a tough pill to swallow. More crypto drama, though. Crypto firms Genesis and Gemini are being charged by the SEC for allegedly selling unregulated securities. What can you tell us?
Right, yeah. So the SEC is filing a litigation action against Gemini and Genesis, and part of it is requesting relief, monetary penalty from court, plus disgorgement for any ill-gotten gains. What that basically means is that they want to fine them, and we don't know how much money that is. But to be clear, the SEC is not charging them, is not calling out cryptocurrencies as securities. They're referring to the loan program that was sort of struck as a business partnership between Gemini, the crypto exchange, and Genesis, the crypto prime broker, or the closest thing crypto has to a prime broker. And in this lawsuit, it's sort of just the latest problem that these two companies have been dealing with thanks to this Gemini Earn program. Essentially, that program offered Gemini customers the ability to lend their assets for or deposit their crypto in return for a yield. And this is like crypto lenders we know, Celsius Network, Voyager, BlockFi. But Gemini Earn's program is different in that Gemini never actually did anything. They created a master loan agreement and allowed their customers to use Genesis's services. So this runs contrary to what the SEC has previously established by way of a settlement it reached with BlockFi early last year and warning Coinbase not to launch a similar project in September of 2021. And prior to the lawsuit, Gemini's president and DCG's CEO had sort of been publicly fighting around Genesis. DCG is obviously the parent company of Genesis. And this all sort of is kind of heading towards bankruptcy. And, I think a lot of people are actually surprised the company hasn't filed bankruptcy yet. And that might come down to how much money creditors want to put over in paying bankruptcy lawyers.
Bumpy times ahead. David Hollerith, digging the Johnny Depp look you got going there. A little Jack Sparrow, maybe?
Yeah, we can go to that.
Good look, brother. Have a good weekend. All right, Johnson & Johnson is reportedly cutting production of its unpopular COVID-19 vaccine. Anjali Khemlani back with us, second time in studio. Lucky for us on a Friday. What can you tell us?
Well, I can tell you that this slash in production is happening again. This is the second time that we've heard of Johnson & Johnson slashing its production, but specifically this time around, according to reports, the company has cut back on its contracts with the manufacturers it was working with, including Catalent and Sanofi. We did hear earlier on last year from CFO Joe Wolk. Here's what he had to say then.
Right now, we are, like we would do for any product, right-sizing our manufacturing footprint, our R&D programs to kind of correlate better with the demand that's out there. And so we are tapering back, but we're still in the business. We're going to meet our regulatory as well as our commercial commitments, and just right-sizing it for really the business prospects that are out there.
That commercial commitment's really a key point there, because that has been the focus of a few cases that have happened, or not really cases, but let's talk about it in terms of arbitration, specifically with Merck, one of the manufacturers that came in to help save Johnson & Johnson at a time that it had manufacturing struggles early on the pandemic. We don't want to go over the whole history, but it's safe to say that Johnson & Johnson has really struggled with this COVID vaccine during the pandemic, first with issues with reports of blood clots, as well as, the manufacturing concerns. So this just looks, more and more like the company could be close to, maybe stopping. I don't know. I would love to ask them that. And I believe I've had it in the past on whether or not they would actually stop producing the COVID vaccine, considering globally there's no demand for it now.
Yeah, you don't hear a whisper about it, do you? Anj, thanks so much. Great information. Enjoy the weekend. All right, coming up, the price of dairy products has soared over the last year. The CEO of Tillamook Ice Cream tells us what it means for his business next. Americans have been feeling the pinch of high inflation at the grocery store over the past year, in particular when it comes to dairy products. The latest CPI data revealing the prices of household staples like eggs, butter, and milk have risen significantly over that span. The eggs number is baffling, folks. We're talking about 60% year over year, 11% in the last month. But what does it mean for today's farmers? Joining us now to help answer that question is Patrick Kreitzer, Tillamook CEO. I know I called you Tillamook Ice Cream because in my house, sir, you make a lot of stuff. We are devoted Tillamook ice cream fans. My kids didn't even know you made other stuff. Mint chocolate chip, by the way, is the go-to. If you could tell us how those prices of dairy products are impacting your business and your farmers, who you call your bosses.
Yeah, well, there's certainly been a lot of talk about the inflation at the shelf and food prices, and there should be, because that's an 8 to 12%, even higher in some categories. Increase in cost year over year is impacting families. But it's also important to remember what the current economic conditions are doing for the impact that they're having on the nation's farmers. Input costs at the farm level are up substantially. Weather conditions have been challenging. On top of that, farmers are price takers, not price setters. So this cycle of cost increases and then price increases that sort of rolls through other supply chains kind of gets stopped at the farm level in the food supply chain, to the extent that farmers are having to bear the impact of high input costs without the ability to necessarily pass on higher prices. And as a result of that, many farmers across various sectors and regions in the West are faced with a choice about eating into sometimes multi-generational equity on multiple years of losses just to keep the farm operating.
And Patrick, when you talk about those supply chains, some of the issues, the weather, more specifically, really what we've seen over the last week or so with the weather out west, you're based in Oregon, but the massive floods that we have seen throughout the state of California, how big of an impact is that had or will potentially have on your business?
Yeah, it certainly will. I mean, obviously weather conditions have big impact on farming and the environment within which farming is taking place. Just a month or so ago, we had, in a 10-day period, we had an ice storm and then a windstorm that caused power outages, and we're moving generators all around to different farms and trying to keep farms operating. And those same kinds of challenges are what farmers in California are experiencing today. The variability in climate, whether it be the spring we had here in the West, which was not very conducive to growing crops and resulted in feed scarcity, as well as low protein in some feeds, as well as drought that they've experienced in California. Those things just continue to create a high degree of variability in farming conditions across the nation.
Despite the many challenges we've just laid out, Patrick, boy, it seems like on the surface, Tillamook is having its moment. You've been around 113 years, and yet I've never seen more. I've never heard of it more. And again, I'm focusing on the ice cream. What are the business lessons that you've learned over this past trying couple of years, and why do you think you've emerged in this moment?
Yeah, well, as we entered the pandemic in 2020, we were in a phase of national expansion. We had long been, for over 100 years, been a very beloved regional brand. And we had begun to move product around the West and then increasingly into the rest of the country, and the pandemic hit. And one of the things that my team and I did is we sort of circled the wagons and said, we're part of the system that feeds the nation. We need to take that seriously. What are the things that could shut us down? And we did a lot of contingency planning, and we leaned into our obligation to help feed the nation with great tasting ice cream and cheese and cream cheese and other great products. And so we built inventory. We worked around the clock to supply products to retailers around the country. And as a result of that, we were given the opportunity to expand the business pretty substantially during that time. And we continued to take that obligation seriously in the years where we've, certainly subsequently faced supply chain disruption and then, high inflation, high interest rate environment. And so certainly, leaning into our business model, understanding with clarity where we fit as an everyday premium product that people enjoy in their homes has been very important learnings in these last couple of years.
Yeah, it's not just a COVID food that you crave when you're home, but it's probably recession proof. Quick question, favorite flavor? I know it's like picking a favorite kid. Got to give me one.
Well, I have to admit that I've eaten chocolate peanut butter ice cream just about every night for about 35 years. So I'll admit I like what I like.
I like that you admitted that. Mint chocolate chip in my house. Tillamook CEO Patrick Kreitzer, great to have you, sir. Appreciate the time. Enjoy the weekend.
Thanks for having me.
All right, Shauna, what's moving?
All right, Dave, let's take a look at some of these stocks. We have Bed Bath & Beyond, Disney, and WWE, the big stock stories of the week. So let's kick it off with Bed Bath & Beyond. Over the past 5 days, we're looking at gains of about 179%. Of these gains coming despite the fact that the retailer warned that it may need to file for bankruptcy. The New York Times reporting today that Bed Bath & Beyond is in talks with Sycamore Partners to sell assets, including its Bye Bye Baby stores, as part of a possible bankruptcy process. Yet the stock still closing the week in the green. Now, this excitement is spilling over to some of those other meme stocks. And take a look at this. GameStop, AMC, and Carvana on a 5-day basis for the week. You're looking at GameStop up at 24%, AMC up 31%, Carvana up 59%. Certainly not really trading when you take a look at those companies' fundamentals. Let's take a look at Disney. A big week here for the company. A proxy fight brewing between Nelson Peltz after denying the activist investor a board seat. Now, Peltz's firm called Disney a, quote, company in crisis. Also said that its problems are self-inflicted and that they need to be addressed. The push is for Disney to cut costs and also turn a profit for its streaming service. The company also named a Nike executive chairman, Mark Parker, to its next chairman. As its next chairman, he will replace Susan Arnold. And let's round it out with WWE, another big story for the week. The stock closing the week in the green, up just about 6%. Vince McMahon is now back at the company, getting appointed as executive chairman this week as the WWE considers a possible sale. Now, McMahon returns after stepping down last year amid sexual assault allegations. Vince's return comes as his daughter, Stephanie McMahon, leaves the company, announcing her resignation. So who could buy WWE? Something that we've been talking about this week. There's a number of names being rumored, and here are a couple of them. Saudi Arabia's Public Investment Fund is one, Comcast, Endeavor, and the Jaguars owner Shad Khan there. So we will see, Dave, what happens with WWE, but some excitement that we saw in the stock, especially when we saw it peak on Tuesday, but again, closing the week at $89.40 a share.
Yeah, it's a very interesting story to watch. I'm not ruling out the Saudis. Was not true earlier this week. Still feels likely they've hired Rain Group to sell potentially all of that company, a big performer.
All right, well, coming up, YouTube is reportedly looking to expand its streaming ambitions. We will have the details for you. And one TikTok influencer is helping job seekers when it comes to pay transparency. Learn how she's doing it next.
YouTube is testing its own slate of ad-supported streaming channels and is reportedly in talks with media companies to feature their shows and movies on a hub of cable-like channels. Yahoo Finance's Ali Canal here with more information on this. An interesting development as media environment continues to swirl.
And I think this is another step for YouTube to really establish its overall streaming dominance. We just recently saw that it won the exclusive rights for NFL Sunday Ticket. That was a highly sought out asset. They won that. They already have YouTube TV. They have a streaming service store called Primetime Channels. And now we have this report from the Journal that they want to be a Roku of sorts. They are testing this concept with a small number of media partners. It could launch later this year if that testing is successful. But we've seen this free ad-supported space do very well over the past several years, like Paramount's Pluto TV, for example, continuing to grow. And according to S&P Global, there are 20 free ad-supported TV platforms in the U.S., and ad revenue from this type of service is expected to rise from $4 billion in 2022 to $9 billion by 2026. So lots lots of potential there. YouTube is a really big revenue driver for Alphabet. They have the money to do it. Of course, there's this slowdown in overall ad spend, but I think here the potential reward outweighs the risk. And if you have the money to play with it, why not try something like this?
We will see whether or not it's going to be successful. What do you think?
I think it's an all-out takeover by YouTube in the next 10 years, frankly.
I know. You don't exactly want to bet against Alphabet and Google, that's for sure. Ali, we also want to talk about what's going on with Warner Brothers Discovery because they are looking into selling the rights to its music library. What can you tell us about that?
This would be a huge sale, reportedly valued at more than $1 billion. We know Warner Brothers Discovery is at this point that they really want to deleverage their balance sheet. They're restructuring the business. Now, the company is in the very early stages of weighing a potential sale, and any deal would come with certain caveats like protecting usage for talent and also retaining sellability in order to use the music in Warner Brothers produced sequels and spin-offs. But you know, it's interesting when we talk about the selling of music rights, because this is coming at a time when we've seen the value of a song and a record really balloon amid the streaming dominance that we've seen with companies like Spotify and Apple Music. We heard reports earlier this week that Dr. Dre is exploring sale of certain elements of his publishing rights that could be valued up to $250 million. And you're seeing on your screen there, look at these amounts. Stevie Nicks, Bob Dylan, Bruce Springsteen, a whopping $500 million deal. So this is something that for these artists, if they're looking to cash in and make a decent amount of money, this is the time to really do it.
Wow, those are astonishing numbers. That really shows just how valuable those libraries are. All right, Ali, stay with us. We want to stick with the music industry, combine the sports industry here, because Rihanna is getting her fans ready for her much anticipated halftime performance at Super Bowl 57 with this new trailer. Take a look.
It's been 2,190 days.
Dude, Rihanna, we waited for you.
It's been over 6 years since the 9-time Grammy winner dropped her last album.
Everybody's waiting
where
have you been?
We've been impatiently waiting for the last project we got from Rihanna.
The fans just predicted the end of Rihanna.
Everybody has
I am very excited for this. Rihanna kind of disappeared for a few years. We were all wondering whether or not she was going to come back. That hair, we know her style every single time, always delivers. She released her first single in 7 years in October. I'm very excited about this show.
And if you look at the comments to this teaser trailer, everyone is excited. She is one of those artists that really everyone has a positive thing to say about her. She's a boss. I just got chills watching that trailer. And you know, it's an interesting full circle moment because Rihanna turned down the halftime show in 2019 in solidarity with Colin Kaepernick. Since then, the league has made several changes, including the appointment of Jay-Z's Roc Nation to oversee the halftime show. And Rihanna, by the way, is managed by Roc Nation and signed to its record label. But like you were saying, in terms of the new music, she hasn't performed on stage since 2018. Her last big album was 2016. She's really been focused on Fenty Beauty, her fashion line, Savage X Fenty. She's reportedly worth around $1.7 billion. So now I think everyone's ready to see her make new music and get on stage again.
Yeah, she's good. She's like, I don't need the music. But the other night at the Golden Globes, I don't know if you watched, there were several winners who took their time just to say hello to Rihanna because she was sitting so close. And that was a reality check for me. I did not realize how big she was. They were unnerved at the presence of the queen.
And she just had a baby too. I mean, there's so much going on for her right now.
Yeah, there certainly is. I would venture she's one of those names that I think most people know. If you go around the office, I would venture to guess almost every single person.
But how many songs can they name?
Rihanna is. I don't know. That's another good question.
That's another question.
All right, Ali, thanks so much.
I can name quite a few, Dave. I'm just going to put that out there.
I'm about to get the hate on Twitter. She's tremendous.
All right, pay transparency laws aren't making it any easier for job seekers to compare salaries. Employers are responding to the rule by posting insanely wide ranges. Netflix this week posted a job that claims a range of $90,000 to $900,000. Well, one TikToker is taking pay transparency matters into her own hands by asking people what they make. Let's take a look.
I sell waters and Gatorades here at the White House.
Love it. How much do you make?
Roughly $3-4 grand a week.
Wow. How'd you get into this?
I've been doing this for about 15, 16 years. I play on a band, and we used to come down here and play, and I saw the need for hydration for the people down here at the White House, standing out here in the hot sun, and a lot of tourists come down here every day, and they unprepared, and most times they get overcharged at a vending stand, so I come at a fair marketable price at $1, and that's what I do.
Wow, water vendor making $3,000 to $4,000 a week. I wouldn't have guessed it. This is why we need you. Hannah Williams is here, the founder and CEO of Salary Transparent Street. Hannah, it's great to see you. So many people love this. You can clearly see it by your massive following. But tell us about this channel and what got you started.
Yeah, so the channel is really just a compilation of street interviews that I film with my fiance as my cameraman. We travel the country asking people what they do and how much they make. Unfortunately, I was inspired by being underpaid myself in my own career. I found out I was underpaid about $20,000 as a senior data analyst, and that really just opened my eyes to how people can be taken advantage of when it comes down to salary transparency versus secrecy, and things that are really adding to pay gaps that marginalize women, minorities, workers with disabilities, and the LGBTQ community. So I figured the best way to show value is just to demonstrate it with strangers on the street.
And you have exploded, Hannah. When we booked you, everyone around the office was ecstatic. They already watched your videos. Why do you think it's touched such a nerve today? Have you heard that you've helped in that capacity? Hope open up eyes or make people more money?
Absolutely. We have helped people make more money. I get DMs every single day from people telling me that our channel inspired them to advocate for themselves, negotiate their salary, or just look up how much they should be making. And these are things that people are not taught how to do in school, even though we go to school for degrees to qualify for our careers. We're not taught Work 101 and how to advocate for ourselves. So I think that why it's taking off so much is people want to be paid fairly, especially in the light of today's economy, and money goes a long way. If we're being undercut even $10,000, $20,000 in our careers, that can really hold people back. And we're paying attention, we're talking about it, we're making moves.
And Hannah, clearly this resonates with so many people. It's a hit. You have to look no further than your most popular video got over 23 million views. I want to play a quick clip from it real quick.
I'm an attorney. And how much do you make? 134.
How many years of experience do you have?
8.
And any tips or tricks to break into this?
I should say 9. Any tips? Make good connections.
I'm a teacher.
How much do you make?
I make $53,000. How many years of experience do you have? 5 years.
I'm an educator and an artist.
And I am a associate director of family and community engagement. I do social work.
And how much do you guys make? You go first.
Together over 150.
Same with my fiance.
So Hannah, I'm curious, when you go up to these people, how many people are open to sharing this information? And have you seen any difference, I guess, in the trends of that coming out of the pandemic?
Yeah, definitely. I'm so sorry if you can hear sirens behind me. We've got a busy street nearby. But demographics are really interesting. I always say it's like a social experiment every time we go out. We see older generations are less likely to share their salaries or talk about money in general. Younger generations like Gen Z and millennials are way more likely to share. We see more women more likely to share than men. We see white people more likely to share than any other race. It's really interesting how it trends. But usually it's about 1 in 5 people will say yes to the interview. It depends on foot traffic as well.
Fascinating revelations. You say this next video surprised you. Want to get your reaction on the other side.
What does your mom do?
She asks people if they're mad or sad.
Okay. What does your dad do?
He drives trucks with gas inside.
With gas inside, yeah. Do you know how much they make?
No. I know my mom makes $5.
$5. What surprised you there?
I thought her response was adorable. It's something that you can't even script. It was genius to try to talk to kids from a viral standpoint. I was just really surprised that she even knew what her mom did, because her mom was like a psychologist or a therapist. And, you know, that's the best way to describe what those people do from a kid's standpoint. So she's obviously paying attention.
And Hannah, we also have one of the videos that you said is your most controversial. Now let's see why.
I'm a public administrator.
How much do you make?
$242,000 a year.
Can you describe what you do in one sentence?
I oversee homeless programs for a very large nonprofit in the city of Los Angeles.
That's a big role. And what's your biggest struggle in that job?
Not enough housing, not enough housing, not enough housing.
$242,000 for a public administrator. What were the comments that you got on that?
They were not good. I actually had to disable comments on our Instagram and TikTok platform just because they were incredibly negative. And while we're all about transparency, we don't promote harassing or threatening anybody we interview. That's not the name of our game. So I think people were really upset that someone would make such a high salary and be in charge of a charitable organization, a charitable role, especially housing, given the crisis we have with housing in the country right now. But unfortunately, I think that it's a little unfair. We shouldn't be pointing fingers at each other. This isn't an employee versus employee argument. It's an employee versus employer argument. We should be wondering, what is this organization doing? What is their impact? And how are they validating that they're paying such high salaries for people in a nonprofit? I'm sure that she has incredible responsibilities as a public administrator. And so I think that's another part of it, is sharing, what do people do to make such high salaries? How does their cost of living and their experience play into that salary? And we should be able to validate it instead of just wondering. So it's a great conversation.
It is a great conversation. I'm glad you started it. I hope next time you come on, you can interview me, or we can do this on Instagram. We'll have a little salary transparency.
I could ask you right now.
Okay, quick question.
Yep. How much do you make?
Oh, geez, you want to know how much I make? Yes. I make less than $220,000 a year.
Awesome. Do you feel fairly paid?
Ish.
How many years of experience do you have? How
25.
does that make up? Nice. That sounds about right.
That sounds about right. Okay, she said. She said it's. I didn't say how much less. Hannah Williams, great to have you. Wonderful to see what you're doing there on social media. Coming up, there's a big change coming to Arizona iced tea bottles. We'll tell you about it next. The Arizona Beverage Company made a promise to keep its 99-cent cans, but to do so, it had to increase prices on another part of its portfolio. at the start of the year. Brooke DePalma here with the details. Brooke, nice to see you. What are we finding out?
So this 20-ounce plastic bottle, something that customers go to at convenience stores, is essentially going up by 25%. From $1 to $1.25. Now, that's only being implemented in Northeast market right now. As far as if that'll expand into other markets, co-founder Don, who we've had on the show before, said that this is the largest market for that particular 20-ounce bottle, and so he's not quite sure of the timing, and it sounded very unclear if this change will expand. But as you can see there, this raise was in part to offset the cost of that 99 cent to keep that there. But in addition to that, the price of plastic also has gone up. And so he said it ran out of options from speeding up lines and changing bottles. And so this was a decision, the very tough decision that they had to make. And Brooke, you spoke with Arizona CEO earlier. What did he have to say just about the commitment that they have to that 99-cent can? Yeah, well, he sounds very committed. Of course, this is a 3-decade-owned, family-owned company that is. And so he said that they did, in fact, have to undergo what many people are calling shrinkflation. So he said that the reason behind the change and to take future pricing and packing, this is essentially what he had to say.
I don't know what the future holds. We're going to do the best we can and continue to do the best we can to maintain the most aggressive pricing on all our packaging. And, we never want to compromise quality of drink, so that's not an option. And so then we're forced to deal with some of the things that are out of our control. But the can, we're committed, and until something drastic happens, we're going to hold that price.
And it's important to know that the can is now 22 ounces as opposed to 23 ounces. He said that was a change of design. They instead put a 206, he called it, can lid. There was many spillages when they made that size change. He changed that size because of the price of aluminum. I love the 99-cent can. I hope they never get rid of it.
Legendary.
All right, Brooke, thanks so much. Well, that'll do it for us today on Yahoo Finance. Thanks so much for tuning in. We'll see you right back here on Tuesday. Have a great long weekend.